Patience pays, as they say. But if you look at the current market environment, we get a lot of queries from retail investors and viewers tuning in saying, but why do I need to keep patience if from a year-to-date perspective, the index has given a return of 24%? Stocks like Future Retail have gone up 300%. We've had DMart, which has had a stellar listing. A lot of these businesses are performing very handsomely in a short duration of time. How does that really hold ground for investing for the long term, where patience is a key virtue? Tell us how patience still pays in this market.
Yeah, well, I mean, I think if you truly understand those businesses and you understand their prospects, and I mean, let's take VMart for an example. I mean, if an investor has a very good idea of the cash flows that VMart will generate over, let's say, the next 10 or 15 years, you can discount that back to today, and you can figure out whether it is a value buy or not. I think that those are not easy questions to answer for most businesses, and most investors don't even go through that exercise of trying to project out future cash flows and discounting back. And that's one of the reasons why you want to be unreasonable and want very low valuations, because you get downside protection. So, for example, if I look at something like Rain Industries, I did not have to do 10-year projections on Rain. And the reason I didn't have to do 10-year projections is because I knew that in 2018 or 2019, in 1 year, I'll get back what I put out today. And anything that happens after that is going to be just gravy on top of that. So it's very important not to get, one of the worst human vices is envy. Don't get envious because your stupid neighbor is tripling his money every 3 months and he's rubbing it in your face. Don't worry about that. Focus on long-term compounding. Focus on the 15% a year and those sorts of things. Don't try to do 15% a month. Generally speaking, you're going to hurt yourself more than you help yourself. And quite frankly, I would say that in this environment, this overheated environment we're in India, probably better to give the money to professionals. Professionals like I mentioned, Motilal and so on, and let them deal with it. And once you come up with something compelling where you know what the future cash flows are, it's within a circle of competence, all those things, you can always get some of the money back and make that investment. So I would say that treat stock investing, direct stock investing, as an anomaly or as an exception to the rule. Don't try to come up with stock investment ideas every week or every month, because that's just not going to work.
Right, and mandatory disclosure here, as an unbiased party, you believe that Motilal Oswal Asset Management is doing a good job with managing the mutual fund schemes that they run.
Yeah, I have no stock position in Motilal, and I certainly am not getting compensated in any way. I just think that they are, one of the things that's unusual about them. There's two things unusual about them. One is that they do not put out a lot of mutual fund products. They only have, I think, a half a dozen products. The second is that they're only in equity, so they are very focused. The third is they eat their own cooking, and they eat their own cooking in two ways. Ramdev Agarwal himself, I think he's worth like 1,300 crores or something. Every penny of that is in one of the mutual funds, one of his mutual funds that anyone else can invest in. And the second is the company takes its net profit and reinvests it back into their own funds. And out of thousands of mutual fund companies around the world, I don't know very many that do that. In fact, I don't know of any that focus on 100% reinvestment. So they have some unusual DNA. I have nothing to gain or lose whether you go with them or don't go with them. But I think out of the many that I've looked at, they are one of the higher quality players.
And which are some of the schemes from the house that you really like?
Yeah, I don't know exactly what the name is, Focus 35 or Focus 50, but It's the one that's, I think Ramdev himself is 1/4 of the fund. I think they've got about $1 billion or so in that.
Mohnish, I have to ask you about the IPO market because there's so much activity happening there. Now, there are two camps that are approaching this market differently. One camp, of course, believes you go in for the high price names, the consumer companies which are coming to the bourses at elevated valuations, buy them for the listing pop and take your gains on day one. The second is, of course, more focused on the deep structural stories that are bringing about a change in the economy. For example, insurance, right? You've had a series of insurance paper come into the market from the general insurance side, from the life insurance side, and also, reinsurance as a business is picking up, where, of course, you have to keep your faith for the long haul. Tell our viewers what would be the best way to approach the IPO market.
Yeah, so there's a very simple rule of investing I follow, which is never ever invest in any IPOs. And it hasn't hurt me over the decades following that rule. And there's a number of reasons why that should be the mantra for most investors. So first of all, an IPO is a company selling shares into the market. The company controls the timing. The company controls the story. The company has a lot of control over many factors. And they're optimized to maximize the proceeds that the company is going to get. So if the IPO market is hot for consumer non-durables, you're going to see a lot of consumer non-durables come out at that time. And so one of the big advantages we have with equity investing and investing in the markets is that these are auction-driven entities. And auction-driven entities tend to, basically tend to give us pricing that goes to extremes. At times it gets very euphoric, and at times it gets very pessimistic. And as an investor, you can take advantage when things get pessimistic, and usually be a seller when things get euphoric. So, for example, I mentioned, the real estate firms at 1/4 of liquidation value. If I went to those promoters last year and I said to them, listen, I want to buy 25% of your company or 10% of your company or 1% of your company, would you sell it to me at a 20% premium to your current stock price? They would just laugh me out of their office and say, get lost. They wouldn't be willing to sell it to me at 5 times the price that the stock was trading at, because they know what it's worth and they know it's undervalued. So the beauty of the stock market is it allows me to buy those stakes without having those conversations with those promoters. And that's the only reason I was able to buy those stakes. So same thing with Rain Industries. In 2015, the company would not be willing to issue equity at those prices. They would have never issued equity at those prices. But they didn't need to. You could just buy it from unsuspecting adults in the market. So a simple rule to follow is do not buy what is being sold, especially what is being sold by promoters. So just completely sidestep the IPO market. And the second is, you mentioned insurance. Clearly, India has a number of areas, insurance, banking, asset management, and so on, that will grow a lot. They'll grow at multiples of GDP growth, and GDP growth itself will go through a lot. But the investing game is not so much about these macro themes. It's getting down to a specific business. So you have to identify businesses where management is not only honest, they're highly competent, and they're going to go for it. They're going to go for the growth. The second is you have to go for businesses where there are strong tailwinds and which are producing and gushing cash, producing a lot of cash. And when you get that combination at a good price, at a reasonable price, that's when you step in. And the rest of the time you do nothing. So the most important thing after getting fluency on compounding is to have patience. We will not find investments every day or every month or every year. I mean, if you talk to me right now, I can hardly find anything to buy in India. I mean, there's 5,000 companies traded in India. I can hardly find anything to buy. And that's not a tragedy. It's perfectly fine. There will come times in the future when we have plenty of opportunities. And the important thing is when those times show up, to have the will and the resources to act on it.